Hello, I'm Dr. Cheryl Dunn, and this video is to demonstrate the preparation of a classified balance sheet from a list of accounts. So take a few moments and look at the accounts that were given with the balances. So the first thing you should realize after looking at that list is you're not going to use all of the accounts that were given to you because some of them were not assets, liabilities, or owner's equity accounts. Some of them were revenues and expense accounts and do not belong on a balance sheet. And so we're only going to use the ones that are appropriate. Don't worry about the fact that you're not using all of them. You should start by making the heading of your statement. And so we're going to start with the company name, which in this case is Cabaret Muse Inc. And then we write the words balance sheet. And then we write the date at which that snapshot was taken of the company's operations, because a balance sheet is at a point in time. It doesn't cover a time period. There's no beginning and ending. It's just at a point in time. And in this case, it's at December 31st. All right. Then the format of our classified balance sheet is we're going to have assets on the left, as we would with any balance sheet. And then we'll put our liabilities and owner's equity on the right side. Underneath our assets, we're going to have current assets. And then later we'll have non-current assets down here as well. Same thing on the liability side. We're going to start with our current liabilities. And then work down to our non-current liabilities. In this company, the current assets that they have are cash, accounts receivable, and supplies. So we're going to put those in here. The cash is $25,610. Accounts receivable is $19,380. And the supplies were $4,200. We then sum the current assets. And we get $49,190. Then we move on to our non-current assets. And in this case, our non-current assets are buildings and land. Non-current assets are those that will last longer than a year, which is why these were all current assets, because they are all going to be, they're either already cash or they're going to be turned into cash or used up within a year. And so we consider those to be current. The buildings and land are going to last much longer, so we're going to list non-current assets. It's also acceptable to call them long-term assets. And in this case, because the long-term assets they have all fit under the category property, plant, and equipment, you could also label it as that. So we could call this property, plant, and equipment. I'm just going to call them non-current assets. And then I'm going to list the land. And the land has a cost value of $404,130. And the buildings $320,100. Now what a lot of people would do is, instead of writing that $49,190 right underneath that, they would bring it out here. So I'm going to go ahead and do that. And then when I add up the non-current assets, I have $724,230. Okay, and that will give me total assets, which I'll put kind of at the bottom of the page in case my liabilities and equity go down that low. And I add those up and I get $773,420. Okay, now let's look at the liabilities and equity side. We list our current liabilities first. Current liabilities are those that need to be paid back within a year or less. And in this case, that would be the accounts payable, the interest payable, and the salaries payable. Our accounts payable is $17,540. The interest payable is $4,850, and the salaries payable is $24,800. If we sum those, we get $47,190. And then we list our non-current liabilities, and again it's fine to call them long-term liabilities. And the long-term liabilities in this case are the bonds payable, because they're not going to be paid back for 10 years. And our note payable, which was payable, I think it said 3 years. Okay, so the bonds payable is $98,000. I didn't really leave myself room to offset here, so we're just going to have to go straight down. So $98,870. And notes payable of $210,450. And that leaves us total non-current of $309,320, and if we sum all the liabilities, we add the $47,190 and the $309,320, we get $356,510. Okay, so we have another line under that. Then we put in our equity. Our owner's equity consists of contributed capital and earned capital. Our contributed capital is common stock, which in this case is $201,220. And our earned capital is retained earnings, which in this case is $215,690. We then add the equity. We could do a separate subtotal for equity. I'm just going to go ahead and add all three of these numbers since I'm at the bottom of my page. And I'm just going to call this total liabilities and equity. And hopefully we're going to get the same number as we have over here. And indeed we do, $773,420, and so we double underline both of them to show that our balance sheet balanced, and then we go home and celebrate. Thank you for viewing this demonstration. I hope you found it helpful.